Hi, I hope you're getting a hang of the process of generalizing the business transactions. In this video, we are going to look at another set of transactions and try to write journal entries for them. Some of these transactions will help you recall your learning from the previous videos, while there are some new transactions which will help you learn more about how to write journal entries for some complex transactions as well. Let us get started. So as usual, I have the same format on the slide, but I'm going to skip as many steps as possible so that you also get an idea of how to write the journal entry directly. So the first transaction that we have on the screen is capital brought in by shareholders. This is nothing new. We have looked at similar transactions in the previous videos. So I'm just quickly going to do this, to get you into the groove, and then we'll do, more. The other transactions will be done more quickly. So the first step is to identify the two accounts involved. The two accounts involved are shareholders capital, and the money is brought into the bank account of the company. So these are the two accounts involved, number 1 and 2. The first account, shareholders capital, is a personal account because it represents the liability that the business has towards the shareholders. So it represents the shareholders. The second account, bank account, is a real account. The rule for the personal account is debit the receiver and credit the giver. And the rule for real account is debit what comes in and credit what goes out. Using these notes, the transactions should be written as follows. The bank is the real account. It is coming in. Bank balance is coming in. So you write a debit, bank account debit. On the other hand, you have shareholders capital. And now in this video, I'm going to use the alternative nomenclature, not the nomenclature, the convention to write the credit account, which is as follows. To shareholders capital account. Now it is same as writing bank account debit and shareholders capital account credit. It does not make a difference. However, you will see, as I said earlier, in some textbooks, they use this format. There will be some textbooks which can follow this. So do not be worried about, what is this 2. 2 is simply a convention. It represents the account which is being credited. So there is no technical or scientific meaning to the use of word 2 and why this is staggered. There is some space there. It's just a convention to distinguish between which account is being debited, which account is being credited. Let's go to the next transaction. Goods purchased on credit. Now, as soon as we see a transaction in credit, we are interested in knowing the party with whom transaction is being done. So, Madan Lal, he's the person with whom the transaction is being done. Since it is on credit, no cash is being paid. So, Madan Lal, Madan Lal's account is one of the accounts where you should record this transaction. The other is purchase. So you're purchasing goods, so this is purchase account. Purchase account represents the goods that you purchase for resale purposes. All right. The nature of accounts involved. Madan Lal is a personal account. It's an individual personal account. The purchase account is a nominal account. Nominal account because this is an expense. Let me clarify a little bit. Madan Lal is the creditor. He is the supplier. He is the vendor to the business. So this is a liability. That's why I'm calling it a personal account. Okay. The purchase of goods is an expense as discussed earlier, expense item, and hence the nominal account. So for personal account, you have debit the receiver and credit the giver. Nominal account, you have debit expenses and losses, and credit all incomes and gains. So you have a liability here, which is personal account. For personal account, debit the receiver, credit the giver. Now, in this case, Madan Lal is the giver of the goods to the business. So here is the business. Here is, let's say, Mr. Madan Lal, and he is supplying goods to the business. And he's not getting the money back. He is getting a liability generated for the business. So he is the giver of the goods. So debit the receiver and credit the giver. Therefore, I'm going to write to Madan Lal's account. There you go. And which account is to be debited? Now the other account is purchase account. Purchase is nominal because it was an expense. You debit all expenses and losses. So you're going to write purchase account debit to Madan Lal's account. When you write to, you don't have to write credit. They replace each other. So there you go. You have purchase account debit to Madan Lal's account. Next is furniture purchased for cash 10,000. Two accounts involved. You have furniture account. Clearly this is an asset and hence it is going to be real account, and the rule for real account is debit what comes in, and furniture is coming into the business. So I'm just going to write furniture account debit. Already done. You pay for it in cash, and in this video I'm going to take the transactions at their face value, in the sense that it says cash. I'm going to use cash account, not bank account here. So cash again is an asset, it is a real account, and cash is going out in exchange for furniture. So credit what goes out. There you go. So to cash account. Done. And now I'm skipping these steps, trying to make things a little bit faster. You don't need to spend so much time on writing every journal entry. You have to think carefully, but you'll get a hang of it. There are only about 30 to 40 types of transactions that you would get on repeated basis. Once you know how to write a journal entry for capital brought in by shareholders, journal entry is always going to be the same, with slight changes in the name of the person who is bringing in, the amount changes and so on, but the process remains the same. So it's only about getting to know about 30-40 types of journal entries, and then you're done. Okay, let's take transaction 4. Goods sold on credit to Devraj. So goods are being sold. I'm going to take sales account here. Sales account represents the goods, and sales is an income. All incomes are, I should write nominal account. Nominal account. And you debit all expenses and you credit all incomes and gains. So I will write credit all incomes. And goods are being sold on credit. There is no cash involved. Therefore, we are interested in knowing the person with whom the transaction is being done. The name of the person is Devraj. So Devraj's account. He's our debtor. He's our customer to whom goods are being sold. We will recover this money from him. So this new asset is called debtor. This is receivable, as you would better understand it. Receivables. Okay, this is an asset. You will generate temporary capacity from it. The cash will come in within next 1 year. This is an asset, hence a real account. And this asset is increasing. The asset is coming into the business. You debit what comes in. Alright. So you debit Devraj's account. Devraj's account is debit to sales account. And transaction done. I want to, at this point in time, compare this transaction to the previous transaction. The previous transaction, uh, transaction 2 rather. In transaction 2, you were purchasing goods on credit, and in transaction 4, you are selling goods on credit. All right. So the journal entry in transaction 2 was purchase debit to Madan Lal's account. The name of the person from whom we were purchasing the goods, that was being credited because it's a liability for us, which means claims of business go down, hence credit given to Madan Lal. So a creditor is being created, a liability is being created. On the other hand, in transaction 4, goods are being sold to Devraj, an asset is being created, receivable is being created, so his name is being debited here. Okay, and the other side of the transaction is you have a credit to the sales account. On the other hand, in the purchase transaction you had a debit to the purchase account. Both are goods accounts, by the way. However, purchase is an expense and sale is an income. Incomes are credited and expenses are debited. So just trying to show you the contrast. It will start, making a wholesome sense as well. So in effect, the transaction has reversed. When you purchase the goods versus when you sell the goods, the transaction is reversed. The name of the person or name of the vendor or customer, instead, name of the customer is debit here, name of the vendor is credited in purchase transaction. Sale is credited here, purchase is debited there. So I will keep showing you more such comparisons where it will make intuitive sense to you, as to how journal entries are being written and how they compare to each other. Let's look at another transaction. Now, goods purchased for cash. We'll do this transaction and then we'll look at goods sold on cash as well. So, purchase account is involved clearly, purchase account and cash account. In this case, there is no, vendor given, and you're not interested. Even if vendor was, given to vendor's name was given to you, you're not interested in writing this transaction in vendor's account because you don't have to pay to him. And if you don't have to pay to him, no point writing it in his book because writing in the vendor's account means you have to pay to him. Let's be clear about that. Again, purchase is an expense. It is a nominal account and we debit all expenses. So I'm going to write purchase account debit. On the other hand, cash is an asset. Assets are real account. Cash is being paid. It is going out of the business. You debit what comes in and you credit what goes out. Therefore, purchase account debit to cash account, and I'm using a different convention here. I'm using to, I'm repeating it. Does not matter you write to cash account or cash account credit. Same thing, but just to show you that this is another method, I'm using it for this video. Now let me see if we had a cash sale transaction. Cash sale transaction, not yet. Okay. Maybe the next transaction is going to be sale transaction, but let me compare this to the credit purchase transaction, which was, I think, transaction 2. Yeah, transaction 2, goods purchased from Madan Lal. So purchase debit to Madan Lal. Let me write it here. Transaction 2, purchase account debit to Madan Lal. Madan Lal's account. And he's your vendor. Just writing it here for clarity. Okay. Now what is happening in the two transactions is as follows. Purchase is being done. So, both the debit accounts are same across the two transactions, transaction 2 and transaction 5. In transaction 5, you're paying cash for it. So you're just writing cash account credit. But in transaction 2, you did not pay cash. Instead, you have to pay cash in future. You create a liability and you have written the name of that liability. You owe this money to Madan Lal's account. Madan Lal, the vendor, becomes your creditor. It's the liability. A liability is being created. When a liability is being created, it means that vendor has a claim on the business, which is equal to business's claims going down, because an external party's claims on business are going up. So when business's claims go down, it is shown by a credit. So there you go. Madan Lal is being given a credit in this transaction. Okay, just to again compare transactions, trying to help you make intuitive sense of how these transactions are being written. All right, let's go to transaction 6. Goods sold for cash. Now we have the cash transaction. You have sales account and you have cash account. Again, it is cash, no vendor is involved. So, sale account being an income account is a nominal account and we credit all incomes and gains. Cash is an asset, it is a real account and you debit what comes in. Debit what comes in. Using this logic, you are selling goods, the cash is coming in, so you debit cash account debit, and sale is an income, you credit it to sales account. There you go. That is the cash sale transaction. Let me go back to the credit sale transaction. Transaction 4, where we had a credit sale, the entry was Devraj's account debit to sales. So let me write transaction 4 here. Devraj account debit to sales account. Okay, so this is a cash transaction, this is a credit transaction. In both the transactions, sale account is being credited because income is being made. Again, I'm invoking the accrual principle. According to accrual principle, does not matter whether you receive cash for a sale or not. If you have delivered the goods, you have earned that revenue, and if you have earned that revenue, you have to consider it, you have to show it as a revenue. That is what is happening in this transaction. You are writing an entry in the sales account. When you write it there, it means more sales. That's it. You have a notebook for sales related transactions. Anything you write in there leads to you telling anybody who reads the book that a sale has taken place. In this transaction, you receive cash. In this transaction, you do not receive cash. But regardless, you say sales account credit. Credit means increase in the income. So you have more income. The debit account is cash here, is Devraj here. Cash is an asset, it comes in. Devraj is a debtor of the business. He's the customer of the business. He's also an asset, it comes in. So instead of cash, another asset is being created, which is Devraj's account, which is debtors. So that's a comparison between a cash purchase, cash sale, and a credit sale. Okay, let's look at another transaction. Rent paid for shop to the landlord. All right, it says paid already, so I am not worried about the landlord's account. I am worried about the rent account because this rent account represents my right to use the building. This represents my claim. On the other hand, rent has been paid, so and it doesn't say cash, so I'm going to assume I paid it through bank. The business paid it through the bank account. Now, rent is an expense, hence a nominal account. And for nominal account, debit all expenses and losses. Bank account, on the other hand, is an asset. It's a real account. Debit what comes in, credit what goes out. All right. So I'm going to debit the rent account debit to bank account. 3,000 and 3,000. There you go. Bank balance goes out. You're paying for it, and rent debit all expenses. It represents the increase in the claim of the business over the use of whatever shop which you have rented from the landlord. Okay, let's look at another transaction. You receive commission in cash. So I'm going to write cash account. Cash account is involved, and you received commission. So commission has been received. So commission income. You are receiving it, it's your income. Now, if you are in regular manufacturing business, possibly commission is a side business that you are running. So it's a non-operating income. But depending upon the nature of the business, it could also be primary income. For example, if your business is to sell insurance policies, your primary way of earning the money is by way of commission that you get on each premium paid by the customer. So depending upon the type of business, you decide whether it is operating or non-operating. So I'm going to leave that judgment for now. Cash account is a real account because it's an asset. Commission income, it's an income, therefore it's a nominal account. Cash is coming in, so you're going to debit it. All incomes are credit. Again, I skipped some steps here to just show you how do we move forward without going through the working notes. So cash coming in, I'm going to write cash account debit to commission account. All right. Now I want to compare this transaction to a sales transaction. Goods sold for cash here. The transaction was cash to sales. So I'm going to write cash account debit to sales account, and the transaction number was 6. This is transaction 6. Both the transactions have cash account in debit because in both the cases cash is coming into the business. In both the cases, income is also being earned by the business. The only difference is the income is coming in by way of commission here and by way of sale of goods here, right? So this tells us, and if we analyze more such transaction where cash is coming in, you will see that always we debit the cash. We debit the cash because cash is coming in. So whenever next you see a transaction where cash is coming in without looking through all the rules, it should naturally come to you that cash is coming in, cash account is certainly debit. What is the reason for cash coming in? Well, the reason is there is an income. What is the name of the income? It's either commission or sale or interest on a deposit or any other income by way of which the cash can come into the business. That's how you would analyze these transactions. All right, let me look at another transaction. Cash deposited into bank. Now, cash account is involved and bank account is involved. Both are real accounts because both are assets. So what is coming in, what is going out? Well, you are depositing into bank. So bank account goes up, bank account debit, and you're depositing cash. So your cash in hand will go down to cash account. That's it. This was pretty straightforward. All you are doing is converting one asset into other. This is going out, this is coming in. Effectively, cash remains in the business only. Okay, let me look at one last transaction for this video. Cash withdrawn from bank for office use. Now it's opposite of the previous transaction. You have cash account, you have bank account. Instead, in the previous transaction, we deposited cash into bank. Now you're withdrawing cash from the bank. So when you withdraw the cash, then cash is going up and bank account is going down. Both are real account. What comes in is cash. So I'm going to write cash account debit to bank account because bank account is going down 2000 and 2000. So let me just quickly compare bank to cash in transaction 9. So I'll write transaction 9 bank account debit to cash account. So it's just the opposite, you see, the opposite. So when you deposit money, when you withdraw money, it's opposite. So again, it should start making some intuitive sense, regardless, without going through the rules, you should be able to now start writing the journal entries, because it should start coming natural to you. So let me stop here. There is a continuation of this video where we will go through another 10 transactions of similar nature, different natures, some complex transactions as well. So I'll see you in the next video.